Module 6, the Multilateral Development Banks. Here's a fact that surprises almost everyone new to this field. If you add up all the dedicated climate funds we just covered, the GCF, the GEF, the Adaptation Fund, all of them, you get a number that is dwarfed by a different set of institutions that most people barely think of as climate players at all. The multilateral development banks deliver the largest share of international public climate finance in the world, not the climate funds, the banks. So if you want to understand where the money really moves, you have to understand these institutions, how they're built, and why a bank, of all things, ends up being the biggest climate financier on the planet. By the end of this module, you'll understand what a multilateral development bank actually is, and the clever trick that lets it turn a modest amount of government money into a much larger flow of lending. You'll know the main banks that matter for your region, and you'll see how they blend their own money with the concessional funds from Module 5 to make climate projects happen. Let me define the thing plainly first. A multilateral development bank, which everyone shortens to MDB, is a bank owned by many governments together, whose mission is to lend money for development rather than to make a profit for shareholders. We'll call them MDBs from here. Governments around the world are the shareholders. They put in capital, they appoint the board, and the bank uses that base to lend to developing countries for roads, power, water, health, education, and increasingly, climate. The World Bank is the most famous one. But there's a family of them, including strong regional banks, and for you, the Asian Development Bank is central. Now, the single most important thing to understand about an MDB is the trick at the heart of how it works, because once you see it, everything else makes sense. It's called leverage, and it's the reason banks outfinance the dedicated funds many times over. Here's the mechanism. When governments create an MDB, they put in capital, meaning a base of money that belongs to the bank. But the bank does not simply lend out that capital and stop. Instead, the bank goes to the global financial markets, the same markets where big investors buy and sell bonds, and it borrows money there, using its strong reputation and its government backing to borrow very cheaply. A bond, by the way, is just a formal IOU. An investor gives the bank money today, and the bank promises to pay it back later with interest. Because the MDB is seen as extremely safe, backed by many governments, it can borrow at very low interest rates. It then lends that borrowed money on to developing countries at rates those countries could never get on their own. And when the loans are repaid, the money cycles back out again as new loans. So the MDB is borrowing money to lend it out again? That sounds risky. Why is that considered safe rather than reckless? It's the opposite of reckless, and here's why. First, the bank holds a big cushion of its own capital underneath all that borrowing, so if some loans go bad, the losses are absorbed without touching the bondholders. Second, MDBs have an almost unmatched record of being repaid, partly because countries treat these banks as lenders of last resort they can't afford to default on. And third, behind the paid-in capital, there's something called callable capital, which is essentially a promise from member governments to put in more money if it were ever truly needed. That backstop is so credible that the bank is treated as one of the safest borrowers in the world. The result is leverage in the good sense. A relatively modest amount of real government money supports a much larger, revolving flow of lending. That is the core reason MDBs move more climate finance than the dedicated funds. They multiply the government money instead of just spending it. Now let me take you through the World Bank Group, because it isn't one institution, it's a family of 4, and each part serves a different customer. Understanding this structure is genuinely useful, because which part you deal with tells you what kind of money you're getting. The first part is the IBRD, the International Bank for Reconstruction and Development. This is the original World Bank. The IBRD lends to middle-income countries at close to market terms, meaning the loans are cheaper and longer than a commercial bank would offer, but they're still loans that must be repaid with interest. If a country has reached a middle level of income and can service debt, the IBRD is its World Bank window. The second part is the IDA, the International Development Association, and this one matters enormously for the poorest countries. The IDA provides grants and highly concessional credits to the world's lowest income countries. Concessional, remember, means softer than the market, very low or zero interest, very long repayment periods, sometimes decades before you even start repaying. For a least developed country, the IDA is the soft money arm of the World Bank, and much of the genuinely affordable climate money a poor country gets from the bank flows through IDA terms. The line between who gets IBRD terms and who gets IDA terms is basically income. The poorer the country, the softer the money it can access. The third part is the IFC, the International Finance Corporation. The IFC is the private sector arm. Instead of lending to governments, the IFC invests in companies and projects, a solar developer, a bank that on-lends to small businesses, an industrial firm going green. It lends to them and sometimes takes equity, meaning it buys an ownership stake, which we'll unpack properly in Module 9. The point for now is that when the World Bank Group works with the private sector rather than the state, that's the IFC. The fourth part is MIGA, the Multilateral Investment Guarantee Agency. MIGA doesn't mainly lend. It provides guarantees, and this is a concept we'll dig into deeply in Module 8, so I'll keep it short here. A guarantee is a promise to cover a loss if something specific goes wrong, and MIGA specializes in protecting private investors against political risks, things like a government seizing an asset or a currency suddenly becoming impossible to convert and take out of the country. By absorbing those fears, MIGA makes investors willing to put money into places they'd otherwise avoid. So that's the World Bank Group. The IBRD for middle-income government lending, the IDA for the poorest countries' soft money, the IFC for the private sector, and MIGA for guarantees. 4 windows, 1 group. Now to your region. The Asian Development Bank, the ADB, based in Manila, is the regional MDB for Asia and the Pacific, and for a practitioner in Southeast Asia, it may matter more day to day than the World Bank itself. The headline fact to carry with you: the ADB has committed to a cumulative climate finance ambition of $100 billion from its own resources over the period 2019 to 2030. That's a very large number for a regional bank, and it signals that climate has moved to the center of what the ADB does. The ADB works much like the World Bank family. It has ordinary lending for its better-off members and softer, more concessional support for its poorer ones, and it increasingly wraps climate into everything, from energy to transport to agriculture to disaster resilience. There's also the Asian Infrastructure Investment Bank, the AIIB, a newer MDB based in Beijing, founded to fund infrastructure across Asia, and now, like all the others, greening its portfolio and often co-financing projects alongside the ADB and the World Bank. You'll see these banks show up together on the same big project, sharing the load. And beyond Asia, there are sister regional banks elsewhere, in Africa, in Latin America, in Europe, all built on the same model. That habit of co-financing is worth understanding, because it's how the biggest projects actually get done. Co-financing simply means several institutions putting money into the same project side by side, each taking a share. For a really large investment, say a major transmission line to carry renewable power across a region, no single institution may want to shoulder the whole thing, so the ADB, the World Bank, the AIIB, and maybe a bilateral partner each finance a slice, under a shared arrangement. For a developing country, this can be a mixed blessing. On one hand, it unlocks scale no single lender could provide. On the other, it can multiply the paperwork, because each co-financier may bring its own procedures and safeguards, unless they agree to harmonize and follow a single lead bank's rules. When they do harmonize, co-financing is powerful and efficient. When they don't, it becomes another source of the fragmentation and access burden we keep running into. Knowing which banks are already working together in your country and how well they coordinate is genuinely useful practitioner intelligence. If the MDBs already have their own money and can leverage it so effectively, why do they even need the climate funds from Module 5? Why not just do it all themselves? This is where the two modules connect, and it's one of the most important mechanics in the whole field, so stay with me. The MDB's own money, especially the market rate lending, is cheaper than commercial finance, but it's still, mostly, debt that has to be repaid at some level of interest. For a lot of climate projects, particularly adaptation projects that earn little or no revenue, or projects in very poor and heavily indebted countries, Even MDB terms are too expensive or too much added debt. So the bank blends. It takes its own large loan and mixes in a slice of concessional money, from the climate investment funds, or the GCF, or a bilateral donor that is even softer, sometimes a grant, sometimes a near-zero interest loan. Blending that cheap slice into the bigger loan brings the overall cost down to a level the country or the project can bear. So the funds and the banks aren't rivals. The funds supply the concessional sweetener. The banks supply the scale and the delivery machinery. Together, they make a project that neither could finance alone. Let me make that concrete, because blending is abstract until you see it. Imagine a country wants to build a large climate-resilient irrigation and water management system across a drought-prone region. The core of the money might be a big loan from the ADB or the World Bank's IBRD on long, cheap terms. But the resilience features, the parts that protect against future droughts and floods but don't generate extra revenue, make the whole thing a bit too expensive to justify on a pure loan. So the bank layers in a grant or a highly concessional tranche from a climate fund to cover those resilience elements and lower the blended cost. Maybe the IDA is involved because the country is poor. Maybe there's technical assistance, money on top to help design it well. What the country experiences is one project. What's actually happening underneath is several sources of money at different levels of softness stacked together. That stack is the everyday craft of MDB climate finance, and it builds directly on the capital stack idea from Module 3. Let me take a moment to show you what a country-level MDB climate operation actually looks like, because the word bank can make this feel remote, when in reality it lands as concrete programs on the ground. An MDB usually engages a country through a multi-year strategy, a document agreed with the government that sets out what the bank will support over, say, the next 5 years. Increasingly, climate runs right through that strategy rather than sitting in a separate box. So in a given country, the bank might be financing a large grid-connected solar program, and a set of climate-resilient rural roads, and a water security project, and a line of credit passed through a local bank so small businesses can borrow to go green, all at once, all under the same country relationship. Each of those is a separate operation, with its own loan or grant, its own design, its own safeguards. Some are pure government lending. Some involve the private sector arm. Some carry a concessional slice from a climate fund. What ties them together is that single, ongoing relationship between the bank and the country, managed by a resident office and a team who know the country well. For you as a practitioner, that means the MDB is not a distant cash machine you approach cold. It's an institution with people on the ground, a standing dialogue with your government, and a pipeline of projects you can potentially plug into. Knowing the bank's country strategy and where climate sits in it tells you where the openings are. There's a further point worth making about how MDBs handle risk, because it's part of why they can operate where others can't. When a bank has a resident presence, a long relationship, and a portfolio of many projects in a country, it can absorb and manage risks that would fright a one-off commercial lender. If one project underperforms, the bank has dozens of others and a decades-long relationship to fall back on. That diversification, spreading exposure across many countries and many sectors, is another quiet reason MDBs can lend into places and into climate projects that private finance treats as too uncertain. It's the same logic as not putting all your eggs in one basket, applied at the scale of a global institution. There's one more thing you should know, because it's the live debate in this corner of the field, and a practitioner should be able to speak to it. There's a big international push right now to make the MDBs do more with what they have. It runs under names like the Bridgetown Initiative, led by the Prime Minister of Barbados, Mia Mottley, and the G20's review of MDB capital adequacy. The core idea is that the MDBs have been overly cautious, holding more capital in reserve than they strictly need, and that with reforms, they could stretch their existing capital to lend substantially more, at a moment when the climate need is enormous. The reform conversation also pushes for cheaper capital for vulnerable countries, for debt relief, and for pause clauses, which let a country stop repaying its debt when a disaster hits, so it isn't forced to choose between servicing a loan and rescuing its people. You don't need the technical detail yet, and we'll return to it in the final module. Just register that the MDBs are not a settled, finished system. They are being actively pushed to become bigger, faster, and more generous climate financiers, and that pressure is coming largely from developing countries themselves. So, to bring it together, the multilateral development banks are government-owned banks that lend for development, and they deliver the single largest share of international public climate finance because of leverage. They use a base of government capital to borrow cheaply on the markets and lend on at rates poor countries could never get a loan, then recycle the repayments. The World Bank Group is a family of four: the IBRD for middle-income government lending, the IDA for the poorest countries' grants and soft credits, the IFC for the private sector, and MIGA for guarantees. The Asian Development Bank is your regional giant, with a $100 billion climate ambition for 2019 to 2030, alongside the newer AIIB and other regional banks. And the banks constantly blend their own large loans with the concessional money from the climate funds to bring costs down to something a country can actually bear. Underneath, it all runs a live reform push, Bridgetown, and the Capital Adequacy Review to make these banks lend more and lend softer. That brings us to the next channel, the one that's often the most political and, right now, the most turbulent: the money that flows directly from one country to another and the specialized institutions that go with it. That's Module 7.